A major conflict breaks out tomorrow. What's the first thing that happens to Forex? Does the dollar surge? Does gold explode? Do all currencies crash? Not exactly. Because the biggest move usually isn't driven by the conflict itself. It's driven by one thing, where the world suddenly decides to move its money. Here's what actually happens. Why the first move happens. The moment uncertainty spikes, markets stop chasing returns. They start protecting capital. Investors sell riskier assets. Money flows into assets that are considered more liquid and defensive. That's why currencies like the US dollar, Japanese yen, and Swiss franc often strengthen during periods of global uncertainty. Not because those economies suddenly became stronger overnight, but because investors are looking for stability. Forex isn't reacting to the conflict. It's reacting to where capital is flowing. The second wave most traders miss. The first move is usually emotional. The second move is calculated. Once the initial panic settles, traders start asking bigger questions. Will energy prices rise? Will supply chains be disrupted? Could inflation increase again? Will central banks delay rate cuts? Those answers change interest rate expectations. And that's where the longer-term Forex move begins. The headline starts the reaction. Expectations decide whether it continues. Why some currencies get hit hardest. Not every currency reacts the same way. Countries that rely heavily on exports, imported energy, or global trade can experience much larger currency swings. If investors believe growth will slow, money often leaves those currencies first. That's why the biggest losers aren't always the countries closest to the conflict. They're often the ones most exposed economically. The biggest mistake retail traders make. Most traders wait for the breaking news alert. Then they chase the first move. But during major geopolitical events, spreads widen. Liquidity disappears. Volatility explodes. The first move can reverse just as fast as it started. Professionals aren't asking, how big is today's headline? They're asking, how will this change global growth, inflation, and central bank policy over the next few months? That's the move that usually lasts longer. So if another global conflict breaks out, don't assume Forex is reacting to fear alone. Watch where money is flowing. Watch what happens to interest rate expectations. Watch how central banks may have to respond. Because wars don't move currencies by themselves. They change the expectations that currencies are priced on. If you learned something new, comment capital flows. And subscribe to MarketsVox if you want to understand what actually moves Forex, not just the headlines.